last week, we discussed the irrelevance of the dividend policy. Similarly to the capital structure, it does not matter for the shareholders whether the managers give the dividends or not. So paying dividends out, the payout policy is the matter whether you get the dividends early or later, but it does not affect the company's value. So it is not related to the shareholders' wealth, and therefore you should not care about the dividend policy. So I explained about the meaning and the procedure to get the dividends, and I had an example discussing the irrelevance. So we found that the value of the company is not affected by the dividend payout ratio. And however, this is let me just skip this example and talk about the conclusion directly. So at the end of this example, as an investor, you can make your own dividend policy. So this is same as in the capital structure decision making process. The investors were able to create their homemade dividends. And similarly, in this case, regarding the dividend payout policy, investors can also make their homemade dividends. So they can just get whatever they want from the company. So conclusively, so the dividends are not related. It is not relevant to the management of the companies. However, this argument is valid only for the textbook, and in reality there are many factors that may affect the shareholders' wealth through the dividend policy. So let me talk about several real-world factors that may affect the dividend payout policies of the companies. The first is taxes. So there is a company, there is a corporation, and there are investors. So they produce some return, and they are going to pay back their investors, the shareholders, through the dividend. However, here in this process, the cash flows are affected by taxes 2 times, not single time, but double time. So we have corporate income tax before the corporation get the net income or the cash flows for them. And second, when they decide to pay out the dividends to their shareholders, again, the shareholders need to pay taxes. This is a personal income tax. So therefore, when from the perspective of the investors, the taxes are important factor that affect their preference towards the dividends policy. So it is natural for the investors and corporations to prefer high dividends when they don't have to care about taxes. In other words, when the tax rate is low, dividends are preferred. However, when the income taxes are higher, then dividends are less preferred. They try to avoid paying out the dividends because in that process, the investors need investors experience the negative side of the paying the dividends. So this can be observed in real history. So in 2003, the U.S. government, the U.S. administration, they decided to cut the taxes, especially for the shareholders. So they lowered the dividend tax rate in the United States. And what we see is that before the 2003, the number of companies that paying dividends frequently were at that level. They were smaller number of companies were paying the dividends. However, immediately after the tax cut, you can see that a lot of new companies are paying dividends. This is because now there is no obstacle. So there is no obstacle of paying taxes, so they can give the investors what they want, the dividends. So this reflects the fact that the taxes are important matter in the decision-making process of the dividends. And the second one is our flotation cost. So here the flotation cost means the cost related to issuing new securities. And sometimes the companies may not have sufficient cash and still they want to pay the dividends. And what they can do is that they can borrow from others or they can issue new stock. So they have to incur the flotation cost because they have to get financed in order to pay the dividends. So therefore, when the flotation costs are lowered, when there is no financing cost, then they may prefer higher payout. They may prefer higher dividends. But on the other hand, when there are a lot of financing costs, they may avoid paying the dividends. And the third factor is the investor's preference. So in some countries like United States, many retired people rely on the dividend income for their lives. In Korea, the financial markets are not that highly developed. Therefore, we often our retired people often rely on the bank savings for their rest of the lives. However, in the United States, what they usually do is that when they are working, they frequently buy the shares from the New York Stock Exchange, and they have a bunch of portfolios in stock and the bonds. And later, after they retire, after they quit their job, they get the dividends from the portfolio and they can maintain their quality of the lives using the dividends. So for these older generations, it is important to get sustainable level of dividends. And if these people are taking a majority of your shareholders, then as a manager of the company, you should always care about their lives. So therefore, you cannot quit paying for the dividends. You need to keep paying the dividends for them. So because some investors prefer paying regular dividends, the companies also need to pay the dividends regularly. So those investors who only invest, they are going to purchase the shares when the companies are paying regular dividends. So this will affect the stock prices and therefore the company managers also need to care about the dividend payout policy. And the fourth factor is about the information, or more broadly speaking, this is about the information, asymmetric information. I'm sorry. So in many cases, we see that companies and investors have a different level of information available. So company managers and company insiders know much better about the future. However, the investors in the stock market may have limited information, so they don't know about the precise future information. And in that case, the information is so important, so it may affect the dividend policy. So the situation is like this. So sometimes some companies choose to cut their dividends. So before the change, they were paying regular dividends 4 times in a year, and then suddenly they declare that they are going to stop paying the dividends. And investors will try to figure out the meaning of this decision. And what they conclude is that before the change, the company had a lot of cash, but they are stopping dividends because they don't have cash. Why do they have no cash? Because they are running out of the money, because their businesses are worse than before. So what they think is that from now on, the stock price will go down. So they panic and they start to sell the shares. And it will affect the stock prices, so stock prices actually goes down. So cutting dividends can be the bad signal, suggesting worsened profitability of the companies in the future. And reversely, if investors get unexpected higher amount of dividends, then it can be considered as a good signal about the performance of the companies. So changing dividend policy implies something. So it may affect how people think about the company. So as a manager, you should be very careful when you try to change your dividend policy. So companies often try to avoid changing dividends. They try to maintain the current level of dividends they are giving to their shareholders. And to do so, it is important to let them happy with the current situation. So from the beginning, companies will try to not to make a large amount of dividends, because if they give dividends this time and then if they quit later, then it will be a bad signal. However, if you just give smaller dividends and if you continue to give smaller dividends forever, then everyone is happy. So that's the information content effect. So the dividends are information. Dividends are signal. So you should be very careful. And the last one is about clientele effect. So this is about this is also related to the previous argument, the desire for current income. So investors have their own preference. Some people prefer stock with higher dividend yield. Some people doesn't want to have dividends, but rather they may try to get a higher stock price because of higher growth rate. So we can classify the stocks into 2 groups. One group of the companies are the companies with a potential to grow. This is like Amazon, Google, or Coupang. So these are very rapidly growing companies. So they can compensate their shareholders not because they are paying dividends, but their stock prices become higher and higher every day. So that is how their shareholders can be satisfied. They can enjoy higher stock prices, so they don't want to get the dividends. Rather, they want the companies to continue growing. On the other hand, there are matured firms like Coca-Cola, McDonald's. So these companies are already in mature, so they are not growing well. And in that case, they try to pay the dividends, and investors are investing in these shares because they want to get the dividends from these companies. So the purpose of purchasing some stocks is different for two different groups of the shares. And then the clientele effect explain that because the investors are already having their purposes, so you should not change your policy. Because as investors, those who are investing in Coupang or those who are investing in Nvidia, they are expecting low dividend and higher growth. On the other hand, those investing in Coca-Cola, for example, they are not expecting higher growth, but they are expecting higher dividends. So it is natural for the managers to let their shareholders be happy with their expectation. So if you change your policy, then actually it will make your existing shareholders very, very angry because you are breaching your implicit promises with your shareholders. So shareholders will be happy if you continue to keep your promises. So you should, as managers, you should let your shareholders be happy with your by continuing your dividend policy. So this is what the clientele effect suggests. So these are some of the real-world factors that may affect the dividend policies of the corporations. And now let me talk about alternative way of the payout. So there are stock repurchases, and we will learn that the stock repurchases actually have the same effect as the dividends. So what is stock repurchase? The stock repurchase is repurchase of their own shares by the companies. So if a company purchases its own shares from the stock market, then it is called stock repurchase or share repurchase or the share buyback or the stock buyback. So in any case, this is a repurchase and this is a buyback. The reason that we call it repurchase or buyback is because at the time of the IPO, the companies sold the shares of the companies to the investors. So from the point of view of the investors bought the shares from the company already. So this has done before. And now the positions are reversed. Now the companies are buying the shares from the investors, or the companies are purchasing the shares again from the investors. So that's why we call this process as stock repurchase or buyback. And then this is actually the same as paying the dividends because the companies pay the shareholders certain money. And there are several ways to do so. One of the ways is to have open market purchase. So the open market purchase is just pretending as a usual stock market investor and purchase some of the shares from the stock market without notifying that you are the company yourself. On the other hand, there is another way, which is a tender offer. So this is a tender offer. The tender offer means that you are going to make an announcement, big announcement to the stock market investors that from now on until day something, I'm going to purchase my own shares from the stock market. So everyone knows that this company is doing stock repurchases. So this is the tender offer. And for some of the companies which are not listed in the stock market, they can have also targeted repurchase. The targeted repurchase is purchasing the shares directly from designated someone who are well known. So this is a more direct transactions, while others are anonymous investors. So while open market purchase and tender offers are buying the shares from anonymous people, the targeted repurchase means that you are buying the shares from the specific investors. So this may not be possible if your company is already on the stock market. Because if your company is in the stock market, then there are the number of shareholders is so huge, so that they may argue that why not my shares? So if you cannot just let someone to enjoy the benefit of the stock repurchases, but you have to make everyone to be treated equally if you are already in the stock market. So that's why the target repurchases may not be possible if your company is a public one, if your company already had the IPO. However, if you are already on the if your company is already on the stock market, then maybe you can rely on the open market purchase or the tender offer. So then let me compare between the dividends and repurchase. Let me give you the conclusion first. So there is no particular difference between dividends and share repurchases from the shareholders' point of view. However, there can be some technical issues whether you prefer dividends or share repurchases. So let me talk about this through an example. So suppose that our company is 100% equity financed. So we are not going to talk about the capital structure. So we are going to assume that we have no debt at all. And it has cash excess $300,000. So now at this moment, we don't have good options or choices or investment opportunities. So we try to give it back to our shareholders. And currently, the number of shares outstanding in the stock market is 100,000. And the company's value is 1 million. And because we don't have that, it is also the same as the market value of equity. And this year, the net income is $49,000. And at this moment, now consider the current performance measures of the company. So, stock price. The stock price can be calculated by dividing the market value of equity, which is 1 million, with respect to the number of shares outstanding, which is 100,000. So it gives you that the stock price should be $10. And then earnings per share is calculated as the net income, 49,000 divided by the number of shares, 100,000. So the EPS, earnings per share, is 49 cents per share. So the price to earnings ratio, PE ratio or PER, is stock price over the EPS. So it is 10 over 0.949. So it is about 20. So this is the current situation. And now the company decide to have dividends. So it will give the shareholders the excess cash 300,000. And then, so it should give the dividends equally distributed to all shareholders. So the dividends per share is 300,000 divided by the number of shares. So the dividends per share is $3. So if you have 1 share, you get $3. If you have 10 shares, you get $30 from the company. And because the company spent $300,000 by dividends, so the company's value decreased. So the new value of the company is 700,000, and because the company has no debt, this is equivalent to the market value of equity. So therefore, the stock price is now 700,000, the market value of equity, divided by the number of shares, 100,000, so this becomes 7. So it seems that the stock price was 7, however, now it becomes, it seems that the stock price was 10, but now the stock price becomes 7. So there is a loss of $3. So this is what we observed in last time, which is the ex-dividend price drop. So here we can see that the stock price drop $3 is exactly same as the dividends per share. So actually from the point of view of the shareholders, there's nothing happened because before the dividends, a single shareholder with 1 vote, 1 share, had $10 worth share. So he had $10 as his asset. However, his asset was in the form of the share. However, after the dividends, now the stock becomes $7 worth. However, now he has $3 in cash. So in sum, he has still $10, which is not different from the previous wealth of the shareholder. So nothing happened. But the only thing happened is that he had everything in the form of the shares on the stock, but now some of his wealth is converted into cash. But that's the everything that happened. So from the point of view of the shareholders, the dividends does not affect his wealth. So this one again represents the irrelevance in the dividend payout policy. And the earnings per share is not affected. EPS is still the same as 0.49. However, the stock price have changed, so the price to earnings ratio changed. The price to earnings ratio is now 7 over 0.49, so it is falling from 20 to 14. So seemingly, it seems that the company's performance measure is deteriorating. However, actually not. It is just a looking what we see. However, in fundamental, there is no change in from the point of view of the shareholders. And then let me talk about the alternative, which is repurchases. And the company spends 30,000. The company spent 300,000, and the stock price is $10. So the number of shares that the company can buy back is 30,000 shares. And the new number of shares outstanding will be 100 minus 30, so it becomes 70,000 shares. So here you need to note that in the process of stock repurchases, that once the company buy back, the shares will be eliminated. The shares will be canceled when they have stock repurchases. So therefore, the number of shares become lower after the stock repurchases. But for the Korean students, this may not be true in case of Korea, because in most of the countries, like including the United States, if you have stock repurchases, automatically you should eliminate the shares that you bought back. However, in Korea, it is suggested, it is recommended to do so. However, sometimes the companies in Korea just hold the shares without removing them. And then suddenly, maybe after 1 year or 2 years, they sell the shares once again. So the number of shares outstanding does not go down, but it comes back once again to the original level. So that's the one major governance issue that Korea has, because stock repurchases are not actual stock repurchases in Korean market. So that's one critical point, and one of the reasons why Korean companies are devalued, undervalued compared to the global companies in the rest of the countries. However, at this moment, I'm not knowing about the legal changes about the stock repurchases in Korea, so you can just forget about it. But for when you analyze the Korean market, you should keep in mind that the stock repurchases are not in effect in Korea. So anyway, let me come back for this point. So usually the number of shares outstanding should go down after the stock repurchases. So it becomes 70,000, and the company spent 300,000, so the market value of the company should become 700,000. And then the stock price is the value of the company divided by the number of shares, and it is surprisingly $10. So there is no change in the stock price after the stock repurchases. So here, as investors, as shareholders, you have three choices in stock repurchases. First, you hold your shares. So in that case, you had $10 stock, and still you have $10 stock. So nothing happened. You have the same value before and after the stock repurchases. Another choice, that you sell it to the company. So you respond to the tender offer. So you give your shares to the company. In that case, you had the $10 worth stock, but you give it to the company, and the company pay you $10. So you get $10 cash. So again, the form, the container has changed from stock to cash, but the value itself does not change, right? And finally, another way is that you sell to other investors. Then, previously, you had a $10 stock, but now you sell at the after repurchase stock price to other investors. But the stock price after the repurchase is still $10, so you would get $10 again. So you would get $10 in cash. So in any case, you have the same result. But the only difference is that whether you have stock or you have cash. So that's the only difference from the point of view of the shareholders. So in that sense, stock repurchases are same as dividends and they are irrelevant theoretically. But let me talk about some technical issues in reality. So earnings per share change because the number of shares has been reduced. So before the stock repurchase, the number of shares was 100,000, but now it is only 70,000. So EPS seemingly, it is like that the EPS is increasing, but their fundamental is the same. However, they are earning the same net income. However, because the number of shares have changed, so the EPS seems like they are increasing. And the price to earnings ratio is the same as the dividends case. So in the case of the dividends, the price to earnings ratio is 14 about, and that's the same in case of the stock repurchases. So there is no change. So if you compare the dividend versus stock repurchase, then we can have price. When we compare in terms of the price, in the case of the dividend, the price falls, but there is no change in the stock repurchase. And if you look at the EPS does not change in case of the dividend. However, in stock repurchase, the EPS increases. For the price to earnings ratio, the price to earnings ratio are the same in both of the cases. So if you compare these results, what is your conclusion about your preference? Everyone will answer that stock repurchases are better because actually they are same. However, it seems like if you choose the dividend, you have a negative aspect that your stock price falls. But actually it's not. However, it seems like from the shareholders' point of view, it seems like they are losing money because the dividends have a dividend stock price drop. However, in case of the stock repurchases, nothing happens for the stock price. So they are happy. And also, if you look at the EPS, they are also happy because their company's EPS is increasing. So this is also related to the manager's incentives because some of the CEO's compensation is linked to the EPS. So when they have a higher EPS, they can have bonus at the end of the year. So it creates some incentives for the managers to prefer stock repurchases because they want to boost the EPS for short term. So in reality, although there is no fundamental difference between the dividends and the stock repurchases, many CEOs and CFOs prefer stock repurchases compared to the dividends. So that's what we learned from this example. So here you can see this trend toward two different choices. So what you see, the blue line here is payout in overall. So it includes dividends and repurchases together. And there is an upward trend. So companies, managers are learning financial management and corporate finance, maybe through their MBAs. and they are learning that it is better for the shareholders to get some payout. So the number of companies are increasing in this overall trend. However, if you compare the repurchases, the yellow line, and what is this color? If you compare this dividend line, you see that before 1990, the dividends were more popular. However, nowadays, stock repurchases are more popular. So this is also same in the next figure. Although the overall fraction of the companies are increasing with whatever they pay out, however, the ratio of the companies which choose repurchases are increasing. But actually, the dividend paying companies are decreasing. So as time goes by, repurchases are becoming more and more popular compared to the dividends. And a second observation you can have is this. So the number of the dividends paying company is smoothly increasing, and furthermore, they do not go down dramatically. However, if you look at this yellow line once again, there is a sharp decline. It is 2008 and 2009, 2010. These are the period that everyone suffered from the global financial crisis. So this is the economic disaster. And when they suffered, they were able to cut stock repurchases. So this is the another advantage which is hidden for the stock repurchases. But on the contrary, the dividend paying companies still they are paying the dividends even though they are in difficult situation. So this is also related to the real world factors. When you cut your dividends, this is a very, very bad signal that your company's performance is worsening. So, to avoid such interpretation, the dividend paying companies should continue paying the dividends, and that we can find from this figure. So, even despite of the global financial crisis, the dividend paying companies still paying the dividends. However, for the stock repurchases, surprisingly, the investors do not have this interpretation. So they are not affected by the stock repurchases. So the companies can give stock repurchases when they are doing well, and even if they stop stock repurchases, nothing happens. Investors will be also happy with that. So as the corporate managers, you can choose the timing of the stock repurchases, and you have flexible options to do so. So that gives you another advantage to prefer the stock repurchases than the dividends. So, conclusion. Dividends, it is concentrated on large companies, mature companies. The younger, growing companies, they do not pay the dividends because for these companies, it is more important to grow. It is more important to retain their earnings so that they can invest in important projects. And then later, because their company is growing, the stock price will go up, and by doing so, shareholders will be happy even without the dividends. However, if your company is already mature, then and if you have nothing to do, then it is better to pay out the dividends. So you can imagine about the Samsung Electronics. So the situation is slightly different at this moment because now Samsung is suffering. However, so for the international students, let me give you some of the Korean specific information. So Samsung, the owner family of the Samsung is Lee family, and their founder was Byung-chul Lee, and it was inherited to the second generation, and it was run by Gon-hee Lee, and now it is on the third generation, which is Jae-yong Lee. So he passed away several years ago, and while Gon-hee Lee was in charge of the Samsung group, Samsung Electronics was infamous for not paying the dividends, even though it was already a global conglomerate. And he claimed that Samsung has a lot of things to do still, so we need to concentrate on growing rather than trying to distribute our returns to the shareholders. It is too much to call for our victory. So that's why they didn't pay the dividends, even single dollar. So that made a lot of foreign investors angry. Anyway, at the time, Samsung has some reasons why they do not pay the dividends. And after the ownership was inherited to the third generation under the management of the Jae-yong Lee, they started to pay out the dividends. And they suggested that now the Samsung Electronics is immature. So from now on, we are going to pay certain dividends to our shareholders. So that's what they said. So you can see that this is also a kind of signal that under the leadership of the Jae-yong Lee, they don't have important investment opportunities. They don't have nothing to do. They have nothing to do with the cash, so they are distributing the cash to the shareholders. So fundamentally, nothing have changed. However, as an investor, if you have all of your money in stock, then what you have to do is just wait for the stock prices to go up. So it depends on the corporations, not you. However, if you have the cash, then you can have investment. So you can choose to invest in other companies' stock. For example, by selling Samsung Electronics shares, and you may invest in SK Hynix, or you may choose Naver or Kakao. So it gives some flexible options to have cash. So that's another reason why mature companies need to pay out the dividends, to give some options for their shareholders, because their company's stock price will not go up for some in the short run. So that's why dividends are concentrated on large and mature firms. And second, there is a signal effect. So cutting dividends are dangerous because it gives some intuition that your company performance will go down. So therefore, managers try to avoid that situation. And third, and therefore, they try to make a smooth transition. So from the beginning, they do not pay high dividends. If they want to pay the dividends, they start from very small amount and gradually they increase the dividend to maintain the trend. So by doing so, it can give some expectations, rational expectation for their shareholders. It will not breach your implicit promises to your shareholders. And fourth, if you change your dividend policy suddenly, then it will affect negatively your stock prices. So these are the responses from the survey on the CEOs. And 90% of the CEO say yes to the question that do you try to avoid dividend cuts? And they say yes. Do you try to maintain a smooth dividend over time? And they say yes. Do you consider the size of the recently paid dividends when you choose your next dividend? Yes. Do you make sure that any changes you make won't have to be reversed? Yes. So it shows that CEOs and CFOs are caring about maintaining sustainable, smooth dividend policy. And also, they say that having consistent dividend policy is that their priority. So 84% of the CEOs answer that this is a very important thing. So once again, it is even important than attracting new investors. So this result indicate that maintaining a sustainable dividend policy is so important for the corporate managers. Okay, so we talked about the stock repurchases and the dividends. And so we theoretically learned that the dividends and stock repurchases does not affect the company's value. However, in reality, there may be certain impact on the shareholders' wealth. So we are going to learn through the case study in the next Monday. And for the rest of today's session, let me talk about the stock dividends. So far, we talked about dividends and dividends and dividends, and these dividends are cash dividends. So you pay cash, you pay money to your shareholders. However, stock dividends are different. Stock dividends are giving stock, new shares, to your existing shareholders. So we have different terms indicating similar situations. So the stock dividends are payments in the form of the stock, and the stock split is splitting your single share into multiple ones. So originally this was 1 share, and now it becomes 5 shares or 10 shares. So this is the stock split. However, these two have the same effect because they increase the number of shares. And this is different from the seasoned equity offering because in the seasoned equity offering, you give the shares to your investors, but in return, you get the money. However, in the stock dividend or the stock split, you get nothing. The company gets nothing. However, you just increase the number of shares and you give it to your shareholders. So therefore, it should not positively affect your firm's value. So let me give you this example. So Peterson has 10,000 shares, and currently the stock price is $66, and the company decide to have 10% stock dividend. So it means giving 10% of the stock, new shares, to the shareholders. So if you are a shareholder and you have 10 shares, then you get 1 shares additionally. So that's the meaning of the stock dividends of 10%. And let's see what happens. The company's value currently is that the stock price is 66 and it has 10,000 shares. So $660,000 is the company's value. However, now the number of shares increases. So you make another additional 1,000 shares and you distribute it. So what becomes is that because in this transaction there is no cash transaction, no cash flow, so the company's value stay the same. However, the number increases, the stock price falls to $60. So if you are the shareholders, so if you are a shareholders with 10 shares, before the stock split or stock dividend, you had 10 shares and each is worth of $66. So your wealth is $660. However, after the change, now you have 11 shares, but the stock price is $60. So you have again $660 in total. So nothing changes. So the value of the shareholders' wealth is not affected by the stock dividends. This is about numbers of shares outstanding only. Then questions remain. Then why some companies try to have stock dividends? Let me give you an example. Sorry that this is written in Korean for the international students. However, let me introduce Amore Pacific, which is a cosmetic company in Korea. So this is one of the leading companies in cosmetic industry. And in 2014 and 15, it peaked its level of the new record on the stock prices, because in 2014 and 15, that was the time that in Asia, some Korean drama became famous, and so Asian people in other countries started to buy some cosmetic produced in Korea. So also in China, there was a lot of popularity about the Korean cosmetic items. So the Amore Pacific's stock prices at the time skyrocketed. And you see that in 2015 April, the stock price is about 3,900,000 Korean won. So this is very huge for the individual investors. So the textbook say that if you are in this situation that the stock price is so high, but you don't have enough money to purchase a single stock, then your option is that first, you buy mutual funds that invest in the Amore Pacific. Then you indirectly invest in Amore Pacific, and that's okay. Second, you borrow from the bank, and you, using the bank's money, you invest, you purchase the Amore Pacific's stock, and you can do it. So there are alternative options, what the textbook says, when the stock prices are too high for the individual investors. But in reality, this is a huge burden. So if you are having 1,000 Korean won only, 1 million Korean won only in your deposit, then you cannot invest in Amore Pacific. So they declared the stock split into 10 shares. So they stopped operations for several days, and on May, they started the transactions again, but you can see that now the stock price is the 10%. So this is because the number of shares become 10 times larger. So the stock prices are 1/10. So now for anyone, it is much more favorable for them to purchase it. So there is no burden. So if you have 1 million Korean won, then you can buy the shares and you can become the shareholders of the Amore Pacific. So that is the argument or the hypothesis why stock dividends or why stock splits exist. Fundamentally, it does not affect the wealth of the shareholders. However, it may help the shareholders and other investors to participate in trading activities because the prices are more affordable, so everyone can join the party. So that is one of the hypotheses or suggestions why, despite the fact that stock splits and dividends are actually bad, many companies are still trying to do so. So that's the last thing that I wanted to discuss in the class. So let me go back to the Amore Pacific's case again. So if we look at the stock price trend, so sorry that this is also written in Korean. Here it says stock split. So this chart is a adjusted version considering the stock split. So every stock prices before the stock split are 10% level, and you can see that in 2015 there was a very rapid price increases, and it continued after the stock split. And that is one of the reasons is because now any individual investors can participate in trading activities, so their stock become more popular. So that affected the stock prices at the time for the Amore Pacific. So the popular trading hypothesis partially explains why stock dividends and splits are existing in reality, but remember that this is not a long term. So in the short run, it may help the investors, but in the long run, it actually lowered the value of the company because actually there are certain costs related to issuing new shares. So you should try to avoid it whenever possible.